Okay, let's make sure you guys can hear me. Looks like you can. Hey, welcome to the Hurley Investments Financial Services Commentary. And it is actually Monday, March the 5th of 2018. I was going to talk a little bit about today about headline trading and what I am looking at not doing right now. As we talk about headline trading, today the Dow is up 336 points or 1.37%. S&P was up 29.69 points or 1.1%. And of course, the NASDAQ being the laggard on a percentage basis, only up 1% at 72.84. If you were to ask me what I was looking to do this week, nothing. And unfortunately, I have new money that's come in. I'm seeing a couple new accounts of about a little over 2 million. And when I'm right here on the Dow, when technically speaking, we're still bearish, I take a peek and I don't have the confidence knowing 85% of stocks are going to follow the major averages. The Dow right now is bearish. Not only that, but we're stuck in no man's land. I would look to see if something's different on the S&P. We're almost crossing over, but did we or did we not hit resistance? Flat on the MACD, almost crossed over. When I see something like this and I can't make a decision on the S&P, still technically bearish because we do not have the crossovers, I sometimes will run on over to my chart. I will make a change. I'm going to add in here the Williams percent R. That was what I first started off with way back in the day. And obviously, let me change this to the S&P 500. If I take a peek, really taking a quick look, right? No crossover there. Got my pop-up ad blocker not working. If we scroll down and look a little bit more, we do not have a crossover on the MACD, but I do have my preceding indicator right here. Now, yes, we could get head fakes, but we haven't had head fakes. All my crossovers are crying out loud. Pretty true. It runs right through. No crossovers, no head fakes to worry about. So I might say we're going to go higher this week. But once again, the main factor is headline. It's headline trading. And what I'm not doing is looking to have to place new money into positions without a sense, without a reason, whether it be technical, whether it be some type of macro event, right? Whether it be a news-driven event, I don't have a reason that justifies putting new money to work. Do I wish that I had put money in earlier today when it was down 100? Of course I did. But the problem is the sideways movement or the range. Well, Kevin, if you can make money in any direction, why don't you put it in with a collar trade or at least a protective put? Well, kind of simple, right? The one thing you don't want to see or you don't want to trade a collar during stagnant movements of stock ownership. So because I don't want to trade callers, I'm having a hard time obviously putting new money to work. If you were to ask me, I probably would have told you that I would expect our markets to trade lower. With that said, for March, I'm already lowering it to we're only going to be down 2%, and we're pretty flat month to date, right? We're pretty flat. March started, went down, kind of made it back up, a V shape. But I think we're going to be down a little bit in March. And my reason why, or why I'm looking at a stagnant to flat month in March, comes down to no selling of stocks end of last year. And I'm looking at tax selling for 2017. And I know that kind of contradicts itself, but the short answer is I think some people are going to take profits here in 2018, book some of that money for taxes last year, and kind of set it aside for the closing of positions that obviously have occurred this year with our 10% drop from the highs. A lot of people are booking some of those profits. So because of that, because of tax selling, which is my expectation since we didn't have a big one last year, I'm looking at a flat month in March, maybe down 2% to a pretty good down month in April. Kevin, why are you changing your position? And it's not that I'm changing it, but I do have an article that I thought was pretty interesting. And in fact, I'm going to go ahead, I'm going to bring a couple of them in because I do find them interesting. I do think they'll be helpful. David Einhorn's fund was crushed again in February. Both Greenlight Capital and Greenlight Capital Offshore, which are two pretty good-sized hedge funds, fell by 62% in February. They were down about 6% in January. So we're looking at over 12%. A 12% decline in one of the major hedge fund players. It's usually pretty profitable. Pretty pathetic because his answer was, the company has never underperformed like this. And that's not necessarily true either. If you do some research, you'll find out that the company underperformed these percentages a couple times last year. Over a 7% drop, I believe. So I don't know. It's kind of sad that someone can't own up to their losses. What he should say is not that the company's never underperformed like this. He should just say, you know what? He's playing to the negative sign. He's shorting too much, and it got him caught. When he went back into getting in and going long, well, then the market sold off. Pretty bad timing. The other point was the Dow just broke its longest monthly winning streak since 1959. We had, it's not going to tell me, I want to say 13 or 14 straight months with the Dow that was up. And again, I don't want to call it not particularly exciting, but in all honesty, the Dow is only 30 stocks. They move winners and losers out all the time. The Dow just had its longest consecutive run and the S&P snapped 10-month winning streak, so their longest since 1959. 10 consecutive months that they were up. There's just a change. There's just a change where, I don't know if you want to call it valuations, but there's just a change that you don't see. You haven't seen the buy the dippers throughout this year until today. I don't know if that means we're going to see a bunch of more money move in, but I can tell you it concerns me. And because it concerns me, at this point in time, I'm having a difficult time, and I'm not really finding the need to try to push people into new positions. Well, Kevin, call or trade. Pick some new positions to get into and call or trade. If we were to take a look at what we have this week, we have Target, we have Ross Stores, Urban Outfitters, Abercrombie & Fitch, Dollar Tree, Celdex, Costco, maybe. VSLR is the Vivint Solar Company. American Eagle Outfitters, Burlington. Kroger's an interesting one. Marvel's an interesting one. Kroger and Marvel. Excuse me. Both in the high 20s. There's some opportunities there, but there's not a whole lot of opportunities. This is the second week of retail. And again, retail doesn't excite me. Well, Kevin, people are going to buy new clothes for summer, and with all due respect, it's the beginning school season. That's where you see the big move for retail. You see that through August and September. So I'm struggling with finding a way or a position to put new money in. Well, didn't Marvel take part? They're gonna do great with the Black Panther or whatever. And they might, but Marvel's more for toy sales. I can't remember hearing or seeing something about toy sales of the Black Panther just flying off the shelves. So there's not a lot there. There's not a lot there that excites me. There's not a lot there that says, hey, this is where I'm going to go stick new money. Kind of sad because I've had some good new money come in, but I'm not finding an opportunity that I'd feel comfortable putting the money in. Headline risk. If I can just make another comment, we're looking at bigger swings on a point basis with relatively close percentage swings that we've seen in the past. And what I mean by that is, we're used to seeing, or I was used to seeing, a percentage swing of 1.25%, 1.5% in options expiration months. I think it was a couple Fridays ago, Jeffrey Dunning and I had a talk. He was like, "Oh, it's so big," and I said, "No, it's really not. It's the same percentage swing." No, that's not necessarily true, and he's right. We went through some runs into where we're having up months on our options expiration, and it was kind of weird to see every 3 out of 4 months options expiration there was some serious short covering, and off we went. It was a 1.25% to 1.33% movement last options expiration. It was obviously to the downside. There wasn't a whole lot going on there, and the numbers look staggering. 300-400 points down on the Dow, 35, 38, or 39 points on the S&P. It can look a little staggering, but they're just big numbers. The percentages are what I've dealt with in the past. So you are seeing bigger point swings, which psychologically is a little difficult to trade into, to buy into. Again, we're always supposed to buy low and sell high, but what if this is the next big run down? What if this is the next big correction where we're going to go 20%, in which case it's quite difficult for us to weather some of these storms. I've got a couple people that I need to find something for, but right now I don't have a good sense of what that might be. So headline trading, headline investing, very difficult to do. And why is it so very difficult to do? Because I'm not going to say you, it is nothing more than a guess. And I think gambling is a guess. So it bothers me because I would never gamble with my money. I would never gamble with other people's retirements, profit sharing plans, IRA accounts, Roth accounts. It's very difficult for me to find new money to go to when I feel it's a gamble. And for that reason, I struggle. I really do struggle with where we're at and how this is going to work. I have not put new money to work, and I'm struggling finding an opportunity. It would surprise me if I found something to put new money to work for this week. I just don't see it out there right now. If you're asking where markets are going to end, I'm going to say higher only because I'm getting my crossover on my MACD, my Williams percent R, excuse me. Obviously, we're still bearish looking at most of our charts. If we run off to the NASDAQ, that's the only one that we can say bullish. Just turn bullish. You'd have it on your crossovers, and we're off to the races. Again, where's market end in March? I'm going to say flat to down. I'm saying 2% right now. Earnings, we already went through this week for economic orders. Big one on Wednesday, ADP employment. And I think we're back to the point where we're going to see bad news is good news and good news is bad news. If we have a strong one, oh my gosh, we're going to raise more. We're going to raise 4 times or more in this year. So good news is bad news. If we show strong ADP employment, we're probably going to go down on Wednesday. Same thing with the non-farm and private payrolls on Friday. Good news is bad news. We have good numbers coming up. You'll see our markets go down. Kind of, it's off base. It's wrong. It'll be interesting to see. Wednesday, I'm going to pay attention to consumer credit. I haven't seen Visa, even though they've got $20 billion to buy more shares. I haven't seen the run up on Visa after good earnings. I thought at least they'd get to 135. Well, Kevin, they had a $7 or $8 run up ahead of time. I get that, but their earnings were so good. With them also buying more shares, I would have thought they'd be at that 135 range. I was okay with saying, hey, Visa can run 12, 14% after its earnings or through its earnings, pre-earnings run and post-earnings. Just hasn't happened yet. I will be ecstatic to see him back up to 220, 127 though, previous highs. If I got a lot of ums going on today. Wednesday, we have a couple international reports which are going to be rather important. China, which has the merchandise trade balance, merchandise. Even probably more specific is we have Japan's GDP numbers coming up. Now, they're really not that important, but it seems like people are going to be looking at, hey, with us out of the trade agreement, maybe something's going to happen. Maybe we're going to see a push to get into better agreements. In fact, I think I also read in NAFTA that maybe he might not sign the steel tariff if he gets more favorable terms in the NAFTA agreement. Kind of interesting that the master negotiator, and I do like Trump for those that want to know, the master negotiator hasn't negotiated very well for any of our agreements. It just kind of made idle threats. We do have the Bank of Japan announcement. This is the rate hikes for Japan. And obviously not something that will move our markets too much. More importantly, we're going to have the CPI and the PPI. We're going to see the inflation numbers from China, see if those are kind of getting overboard. By way of questions, I don't have a whole lot of questions. I'm still looking to own Apple or value investments with more potential upside. Nothing stands out that has a big excitement for me. Nothing that I could say I'm going to look to get out of. In fact, if anything, how am I looking to trade? I will have long puts, sell shares on DH Horton. I think that is kind of run its course. I'm not looking to be in the home builders, even though DH Horton was a great run. Interest rates have people spooked. I don't see the numbers in the homes telling me it's a good time to get into DH Horton. I will sell it off for a profit and look for an opportunity to get back in if the I don't want to call it the feelings, but if the sentiment changes. Keep on going on down. I thought it was interesting. Fidelity puts 6 million savers on a risky path to retirement. A lot of people are moving out of Fidelity Freedom funds because they're taking such high positions in equities. In all honesty, there's just as much risk in the bonds right now after a 32 year bull market bond run. So you could see bonds have just as much of the loss as you would see stocks occur. I went over that last week on where bonds are purchased at a premium, selling at a discount, have some interest rate hikes that make bonds that you bought 6 months ago not near as attractive as bonds that you can get 6 months later. So pretty interesting. But in all honesty, the target date funds, the Fidelity Freedom funds, any of the funds, fees are too dang high. And more importantly, there's really no protection. It's diversification. We learned in 2008 that's not the best way to protect. There are some some ridiculous changes. I obviously can't say the word. I'm tired. I've been traveling already. Some big changes in the way things are being done. Trying not to lose money. I laugh at the fact because all of the money managers are trying not to lose money. But again, diversification is not the way to go. Pension funds have taken a good hit. Hospitals, municipalities, public trade companies, universities, they're all getting hit. It's pretty cool because the ETFs are cheaper for most people. A trade war would be poor and painful for markets. I just brought some information in to take a peek at what a trade war would be. I don't understand why trade is saying trade wars are good because they're not. They never are. And there's our win streak. And really, guys, that's about it. I don't have a whole lot to tell you this week. I was just a little bit worried because I haven't seen something that tells me, hey, great time to be in, great trade to go to. I just don't see it right now. For that reason, I just wanted to get this out to you guys and say, hey, I'm doing some traveling this week. There's not a lot that scares me in the market this week, but there's not a lot that excites me. And because of that, guys, have a great week. Don't do any major trades. Obviously, again, pay attention to those economic reports. Good news is bad news. So a good number on the ADP on Wednesday could bring our markets down. Same thing on Friday with the non-farm payrolls. Have a wonderful week. Appreciate you guys listening in. I'll get this emailed off to you guys so you can listen to it. Thank you for your attendance, and I'll look to see you again next week. Bye-bye.